hide your kids, lock the doors. You're listening to HR's most dangerous podcast. Chad Sowash and Joel Cheeseman are here to punch the recruiting industry right where it hurts. Complete with breaking news, brash opinion, and loads of snark. Buckle up, boys and girls. It's time for the Chad and Cheese Podcast.
Oh, yeah. What's up, boys and girls? Just a couple of guys who like to watch X-Files with no lights on. You're listening to and watching the Chad and Cheese Podcast, Does Data. I'm your co-host, Joel Mulder Cheeseman.
And I'm Chad. What did those numbers say? Sowash.
And joining us, as always, the Sultan of Statistics, the Bigfoot of Big Data, Toby Dayton, CEO of LinkUp, is in the house. Toby.
There it is.
Happy 2024,
Year,
my
guys.
friend. Happy
Yes.
New Year.
What a way to
Happy
start
New
out the
Year.
year, huh?
Yeah. How do you ring it in Minneapolis? Put on a nice...
We finally got some snow. It was kind of nice. We've been waiting a long time. We finally got a tiny bit of snow. So it's finally
you know climate change is real when someone from Minneapolis says, we've been waiting for that snow for a long time.
Mhm.
Good Lord. Good Lord. Well, for those that are listening or watching for the first time, so this is our monthly show where we dig into the Fed data, the unemployment data. Toby, give them a little bit about LinkUp if they don't know and your role there before we get into the nitty gritty.
Yeah, so CEO of LinkUp, and LinkUp is a job market data company, very unique in the space, where our data set is comprised entirely of job openings that we're indexing from corporate career portals globally. So we've got daily data updated real time, highest quality data. We don't have any job board pollution, no expired jobs, no duplicate listings, job board pollution. So it's really sort of real time nowcasting what's going on in the job market as far as labor demand is concerned.
Beautiful.
Toby's being very humble. Like, this is where the Wall Street guys and gals go for their data. This is the real deal. This is the real
Gotta
deal.
get the good stuff. And
Good stuff.
And it
So
comes
let's
from the corporate career sites, right?
Yeah,
No pollution. I like that. Job board pollution.
Job board pollution. Yes.
Is running
Hit that first slide,
rampant.
Cheeseman.
Yes,
Let's
sir.
talk about this. Let's get to this. Come on. So, Toby. Okay, Toby. So last year ended with an unusually strong labor market with the addition of 216,000 jobs in December, keeping the employment rate at a 3.7%. According to the BLS. In 2023, the addition of 2.7 million jobs was created with solid consumer spending and economic growth, despite 11 rate hikes. I'm going to say that again, 11 rate hikes in under 2 years. Unemployment didn't significantly rise, which experts find unprecedented because it is. These results are akin to a labor market achievements not seen since the 1950s. We should be at an all-time high right now, Toby, or should we?
Not since
Yeah,
Leave
it
It to
was really-
Beaver have we had this good of a time.
It was kind of a blowout number. I think certainly better than most expected, and just continues that trend. Is exactly as you said. This soft landing that no one thought was possible. From our standpoint, we had been forecasting that for quite some time. So we were one of the few voices out there calling for a soft landing. And as we said last episode, and for about the last 6 months, really the 3 to 6 months, the soft landing has happened. Even Janet Yellen came out and said, finally admitted what we're seeing might be described as, could be described as a soft landing. So it is there. And I think December's report was just further proof of that, coming in higher than expected. Wages are continue to be strong. Wage growth is coming down a little bit, but unemployment has just stayed very, very flat and hasn't moved a bit. But as you said, Chad, I think underneath the hood, there are definitely some signs of weakness, and we'll get into what our data is pointing to. But even in December's report, you have still concentration in a couple of narrow sectors that are accounting for most of the growth. Labor force participation dropped. You had a bunch of people dropping out of the market. Over 600,000 people in the household survey were not in the job market anymore. So that was a kind of a weak number. And essentially, since the Fed started hiking, we've seen 8 consecutive quarters of quarter over quarter, year over year growth drop. So, and again, that's by design. I mean, that's what the Fed was trying to do, but it is happening. The job market is really slowing down. And I think from our standpoint, the really operative question is, what's that mean for, the beginning part of 24 and even throughout the year? I think the other negative aspect of the numbers on Friday were that October and November were both revised down, which, the survey data continues to get revised down in subsequent revisions. So we expect that's going to continue as we get into January and February, when they revise November and December down again a couple of times. So there is definitely a lot to be concerned about. There's no question.
Hey, Toby, we saw the market just in the year on a tremendous high. The Fed came out and said decreases in 24, which I think really got the market started. And then I believe we had a regional Fed chair talk about maybe even hiking next year, which was a real reversal from what people thought coming out of 2023. Where do you think we are on interest rates at this point? I know you were expecting decreases, and we were even predicting in the last show, like what month they would be decreasing and easing. Like, where are you right now on the Fed?
Yeah. And I'm always a little nervous when I get outside of our lane of job market data, but given the significance of what the labor market means to Fed policy and the economy, it's hard not to veer into that lane. So with a little bit of trepidation, we're sort of, I think we tend to be kind of in the middle ground. I think the debate really is, 75, percent, 0.75 or 1.5 drop, and how many hikes is that, and how aggressive are they going to be, and when's it going to start? We're not forecasting a recession, but I do think that the Fed is going, and some of that is because I think the labor market is going to continue to be very strong and just bounce along at this, sort of this Goldilocks state. It's a full employment environment we're in, but I think there's going to be increasing volatility. And I think that as that turbulence starts to hit, I think the Fed isn't going to hesitate at all to lower rates to keep things on a pretty good.
But from your viewpoint, the job market is doing what the Fed wants it to do.
Yeah, exactly.
At this point, okay.
Yeah, we really have. We've hit that soft landing, and now it's just a matter of kind of keeping it where it is. And I think, on average, job growth, and we can get into the numbers and sort of what we're seeing in our data, but we think that the job growth for the year is going to be a little bit down from where it was this year, but generally we don't see a recession on the horizon.
When you guys say
let's
very
dig
weak,
let's dig into the survey data.
Yeah. So the that is kind of an interesting thing that's been going on, sort of in, again, a little bit of a backdrop to the BLS data, and we've seen it just month after month. The numbers continue to get revised down again and again, and actually the survey results are getting worse and worse and less reliable as kind of a baseline, and you're starting to see that actually creep into sort of the mainstream. There's articles in the Times and the Journal. Financial Times is saying the same thing about government data, labor market data in the UK. It is, I think, generally what's happened is that people are just not responding to surveys at all, and this really points to that in a pretty significant way. Last year, you can see the difference in those two diamonds, the blue and the green diamond. Mm-hmm. Literally, BLS only revised down by 66,000 jobs, and it was under 2% of the delta. So what happens is the survey is they go out and they talk to businesses. They've got a huge model that bases all of their numbers on those survey results, but surveys keep coming in even after the initial release. So there's this 30 days after the initial release, they do a revision, and then 60 days later, they do another revision. That's kind of the final number. And what's been happening increasingly this year is that those 30 and 60-day revisions are coming down really dramatically. So this year so far, and we still have revisions for 23 that are going to come in the end of this month and in February. So February and March, we're going to literally see revisions for November and December. But even without those, the revisions down have totaled almost 500,000 jobs. That's 15%. So it is, people are sort of starting to question what's going on with and how reliable is that data. And it used to be the case that the most heavily traded day on Wall Street was Jobs Friday. It's the most highest volatility and the highest volume, and because of the significance of the jobs report. And now people are wondering whether that is any kind of way to base trades on that data, because it just is, it's becoming less and less reliable.
Any thoughts on why, Toby? Obviously, why is it getting worse?
Well, it really dropped in COVID, and I think basically, they get those surveys out to businesses. Nobody was there, so COVID, it just was absolutely just nobody was responding to surveys whatsoever. But it's kind of stayed that way too. Even back, people just aren't responding to surveys. I mean,
why aren't we using real-time data though? I mean, we've got real-time data. There's no reason to be doing things like it's 1930 or 1950. This is the stupidest shit. And it's like every time we talk about, trying to adjust for inflation or do all these different things, the tools that we have are 1930s, 1950s tools. It's almost like we don't want to evolve into
Just look at the median age of Congress, and it'll tell you why we don't do that.
That's no fucking answer, Cheeseman. That's no fucking answer. We continue to have these issues, and it's actually affecting the market. If the U.S. cares about anything, and those old white dudes care about anything, Cheeseman, it's about the cash, and it's about the money, and it's about the market. So why aren't we using more real-time data?
Well, and it is frustrating because there are becoming alternatives out there, and the emergence of alternative data. We were one of those pioneers as essentially the whole industry around data, sort of exhaust data from web-based companies, is really, it's still a fairly new industry. It really started about 10 years ago, and it's now just becoming mainstream. And again, I think COVID really helped that along, but it takes time particularly for the government, for them to adapt and change and embrace it. But we are starting to see it. We've got actually some research was published at the end of last year from the St. Louis Fed using our data. So we are starting to see that there is adoption here. And as Joel, as you said at the beginning, I mean, a big chunk of our client base is investors and hedge funds and asset management firms who are using our data for the signal that's in there, because it is real time, and not only real time, but it's forward looking. So it's happening. It just is taking a really goddamn long time to get to the mainstream adoption from government. They just move slower than everyone else.
Do you have a take on, ADP historically releases their numbers right before the Fed does. Any thoughts on similarities? Are they kind of divergent, or are they pretty spot on?
Yeah, they have, their record actually, and you look at that bar chart on the right for 23, ADP is got a very good track record this year. They've updated their model a couple of times in the last, five years or so.
That's the key.
They used to basically say that we're not trying to predict the non-farm payrolls. We're just giving an indicator around private sector hiring. Obviously, ADP's got the largest market share of payroll and employees and employers. So they've got really, really high quality data. They used to not necessarily be very highly correlated to the non-farm payrolls, but that's changed. And I'll give them credit for being a very good indicator of what's going on in the job market. It's not quite as forward looking as our data, because it's actually it's payroll, it's numbers, it's the number of new people getting added into their system, and then they've got a really good model around that. Our data is job openings, which is forward looking because those hires are going to come later once those employers fill the opening with a new hire. So there's definitely some differences there, but generally those two are our two data sets have, and from a forecasting standpoint, have tracked pretty closely this year.
Very complementary. I mean, you're talking about forward, and then you're talking about all the payroll stuff. Yeah,
exactly. So, and then, going back into sort of what we're seeing, that's really, and again, this is it's a little bit terrifying, that drop in labor demand, but again, to your point, Chad, it's pretty much exactly what the Fed was trying to do. It's just the question now is, is this thing gonna, what's kind of the trajectory going forward? Is it going to continue to drop and turn into negative job growth, and what's going to happen for the year, and is a recession in there? What's the Fed going to do? So again, it'll be another year, regardless, of massively intense spotlight on what's going on in the job market to get a sense of where the economy is headed, where the Fed is headed.
I think our audience, this is the slide that they're probably most interested in from the recruiters and employers. Is this simply a reaction to money getting tighter and rates getting tighter? Or is there something else, in regards to AI, automation? Like, should we read any more into the decline and the drop any more than just the tightening of the Fed?
I think so. Yes. I mean, I think the Fed tightening is clearly, they have put the brakes on. There's just absolutely no question about it. And it is, and we're going to still continue to see the impact of that. There's still going to be a lag effect of the brakes being applied coming into the market. And I think that's been what has been surprising to a lot of people, is how slowly or how long that lag effect is. So that's definitely a factor. I think the other thing that has happened is really in 21 and 22 is essentially the job market has come into balance. And so labor demand, if you've got whatever it is, say you've got 100 job openings on your website and you fill those jobs, there will be continued hiring and growth, but there, depending on what a company's churn is and what their turnover is, you don't have to keep filling those positions. So as supply and demand come into balance and there is equilibrium that is achieved, it's just natural in a full employment environment that hiring is going to slow down. You can't keep hiring the way it was coming out of the pandemic, which it was just meeting this crazy built up demand for everything, goods, services, people. Everybody was spending, things were just kind of going nuts. And that just was not sustainable. So part of that is just a full employment environment that is now in much better equilibrium. And it's in a really, really nice place these days. And there was a good quote I saw yesterday or Saturday. The CEO of Bullhorn said, we're in this sort of weird state of balance, which he had said he'd never seen before. And I think that that sort of equilibrium is the thing that is really driving some portion of that lessening demand. And then, Joel, I think you're exactly right. I think the third thing is just sort of in this post-pandemic world, companies have figured out there just continue to be automation, productivity gains. I think people have learned, they took a kind of a step function increase in dealing with how to meet their business needs with fewer people. The technology, AI is, I think we're just beginning to see some of that impact, but that's going to be obviously a mega trend going forward. What's that going to do for productivity? And so I think there are a lot of factors that are driving this for sure.
So we saw highlights in 2023. The annual unemployment rate was at a 53-year low. Average hourly earnings at a 4.3%, the third highest since 2008. The fastest job recovery ever. Worker participation rate did tick down, but still at a 21-year high. I mean, that's always been one of the problems, is getting people back into the labor market. And we've seem to be able to do that. Construction for manufacturing hit a $210 billion average rate, which is much higher than, obviously triple that of the 2010, so 10 years before. Construction jobs up by 43,000 in December, and a lot of this is really driven by the forward thinking and strategy of the CHIPS Act. So do we see this being sustainable? I mean, all of that growth isn't sustainable, number one. We know that, and that's what we're seeing here. That's just not sustainable. But as we move forward, do you see this as more of a long-term play? And do you think that we're going to see some pretty immediate hits or reactions in the market to be able to take a look at chips, STEM, and those types of things that we're building up in the U.S. today?
Yeah, no, I think that a lot of those things that you just walked through are the key drivers of what's going to keep the economy in pretty solid shape, regardless of, I think it is, and we've seen this, labor demand can come down actually quite dramatically without a massive uptick in unemployment, without heading into recession. And I think a lot of those things that you just highlighted are some of the key things that are going to buoy the economy and keep it. I think as in sort of a break glass in case of emergency, the Fed's always there to start dropping rates, potentially even faster than they want to, just to keep things buoyed. So I think you've got the CHIPS Act, the infrastructure, all of that stuff again is going to continue to drive investment into the economy. It's going to continue to buoy hiring. There's a lot to be very confident in. Again, I think we're in for some volatility. I think things are going to bounce around. I think we're going to see unemployment might start to tick up a little bit. Again, is when you see there is going to be increased volatility, but net we see that the economy it's just not going to go off a cliff. There's just too many things there that are keeping it afloat, and it's just going to be. I think it's going to stay. We're going to avoid a recession. Now,
knock on wood, baby. Knock on wood.
Yeah, no kidding. There is some. There's some pretty serious. Risks that I think we're in for this year, and you guys.
Speaking of risks, Toby, some of the criticism is that This is too concentrated in too few sectors. So we talk about healthcare, Chad mentioned construction, but some of the sectors aren't being included in some of this growth. You mentioned imbalance from the Bullhorn CEO. What are your thoughts on, some are really hot and some are really, really cold? Is that going to bite us in the butt eventually?
Yeah, I think what we're seeing just across the board in our declines in labor demand, it is really across the board. It is all sectors, all occupations. So demand is dropping. It's quite evenly distributed. It's also being distributed equally geographically too. I mean, it is we're seeing we're not seeing any massive concentrations in any one sector. So I would say that. Again, I think it's generally balance is being achieved in all sectors. You had some overhiring in tech. That's where some demand fell off quickly. Yep. You had protracted demand in leisure and hospitality. That continues to be getting filled with new hires. It's propelled that. But at some point, every restaurant, every hotel, all of those jobs are, and those are high churn. So they're going to continue to be hiring, but I do think that net that balance is coming into essentially every sector. I do think that there are going to be some things from a demographic standpoint. You still have retiring baby boomers. You've still got healthcare that is seemingly could never meet the demand that's out there. It's just this never-ending demand. So there are going to be pockets like that, but those are all kind of getting back to a normal economy. I mean, those things have been true for decades, and we're sort of back into that. The pandemic is sort of moving further and further into the rearview mirror, and we're getting into some more normalization.
And one of the things I found interesting from the data, not necessarily the slides, is that all the states are fairly in the same position. We're not in a place where California is booming or Florida is where everyone seems to be in the same place which I think does indicate some sort of stasis with everyone going through the same challenges as everyone else.
Yeah, it really is. Yeah.
Good. All right, man. So give us a little insight into a prediction for next month, and just a little tease. We might go into more predictions for the year. You need to tune in for next month's show for that. But for February or for January, what you got?
So I'm going to triple down. We've been forecasting a below consensus for November and December. It's come in higher, so we've missed the last two. I'm tripling down. We're gonna have a below consensus number for January. It is, and I think the first quarter is going to be a little bit of the weakest part of the year from hiring and the jobs.
That escalated quickly.
60% of the time.
You know how we do, baby.
60% of the time, it works every time.
All right, Toby. For our listeners and watchers, let them know where they can find out more about LinkUp.
LinkUp.com is the best place. That's the best place to go to find out. And we've got our data nowcasted on our site, so that's the best place to get an overview of what's.
I love when it's simple, Chad. LinkUp.com. Even I can remember that. Another month in the can, everybody. We out.
We out. We out.
Damn it. We hate our podcast software, by the way. Oh, yeah. Just some guys who like to watch X. Damn it. It's Monday. Oh, yeah. Just some guys who like to watch X-Files with no lights on. What's up, boys and girls? You are watching the Chad and Cheese podcast, a.k.a. Damn it. What's wrong with me today?
Too much chlorine in the system.
I don't know, man. The lodge fucked me up. All right.
All those Mountain Dew MILFs that you were on the brain.
What's everybody? I'm your co-host. Okay. Oh, yeah. Just some guys who like to watch X-Files with no lights on. What's up, everybody? You're watching the Chad and Cheese podcast, Does Data. I'm your co-host, Joel Skulder Mulder Cheeseman. Damn it.
Somebody's trying too hard.
This will be a great bonus drill at the end.
Yeah.
Thank you for listening to, what's it called? A podcast. The Chad, the Cheese. Brilliant. They talk about recruiting. They talk about technology. But most of all, they talk about nothing. Just a lot of shout-outs of people you don't even know. And yet you're listening. It's incredible. And not one word about cheese. Not one. Cheddar, blue, nacho, pepper jack, Swiss. So many cheeses and not one word. So weird. Anywho, be sure to subscribe today on iTunes, Spotify, Google Play, or wherever you listen to your podcasts. That way you won't miss an episode. And while you're at it, visit www.chadcheese.com. Just don't expect to find any recipes for grilled cheese. It's so weird. We out!